Recently, I was on a Zoom call with a lady, and about halfway through the conversation, she holds up her tax statement and she says, I just don't know what happened. In the last year, her husband had passed away. Her lifestyle really hadn't changed. It's just the fact that her taxes nearly doubled.
And what's scary is nothing went wrong, no bad investment, no major financial mistakes. Just one thing changed, her tax bracket. Welcome back to the On Track Retirement Show, a show built to help you navigate the real risks retirees recognize.
We want to get you on track, stay on track, and have a confident retirement. My name is Jay Karate.
And I'm Pat Schmidt. This is one of the most overlooked risks in retirement planning. And Jay, honestly, it's one of the most uncomfortable conversations to have because nobody really wants to plan for losing a spouse.
It is unfortunate, it is uncomfortable, yet it can't be avoided. We know that at some point, unfortunately, that reality is going to come into all of the married couples.
And here's what most people don't realize. When one spouse passes away, you go from married filing jointly to a single filer tax rate, Jay. And when that happens, tax brackets don't just adjust, they compress, meaning you can make the same exact income, but now you pay a much larger portion of taxes on that same amount of money.
And we tend to call that the widow or the widower's penalty in this process, because this is the time that it happens. When that takes place, and again, not to be overly dramatic, the reality is you're in a place of grieving. And now you realize this financial situation that's in the background that you may not know about. You may not ever have a conversation about. And not until you go file your taxes either on your own or with your accountant or whoever that may be, then all of a sudden you realize, oh, by the way.
Yeah, now let's layer in what happens most often. Couples come in or we meet with them on a Zoom meeting, or they meet with our advisors, and a majority of their assets are in traditional IRAs and those 401k accounts, those accounts that haven't been taxed yet, which means that every dollar that they pull out is fully taxable. It's going to be taxable to them, going to be taxable to a surviving spouse, or maybe even to the kids or whoever would be the remaining beneficiaries one day. And a lot of this gets ignored. Yeah. And you know, by two camps of people, and this isn't to pick on accountants or tax preparers, but the CPA, they're thinking backwards, meaning in 2026 here, they're looking at last year, 2025, and looking at their tax preparation. They're not necessarily thinking or looking forward. The financial advisor, the wealth advisor, what are they focused on, Jay? They're focused on what investments that they should own or pick. And in that accumulation and growth-focused advisory model, they're not necessarily thinking about or even planning for these specific types of tax traps.
There's a cost of being in this country, and this taxes. We have to pay taxes. That's how the government runs. That's what it's all about. Yet it's often not that conversation that is talked about, that, oh, by the way, we need to know what this looks like for you. We need to know how this impacts you. We need to know what your next status is, because if we're looking back and seeing and paying taxes, that makes sense. If we are looking forward and thinking about investments, well, that makes sense. There's a confluence of those two that are very important to understand, and there is a cost of doing business, taxes. What does that look like? We go from a filing joint scenario, which is a tax advantage. We now have typically two incomes. Maybe that income has changed if the husband was still working or if the wife was still working. But now we've got Social Security. There are all these little ancillary things that just aren't talked about. And we are wise to have those conversations. Sometimes we need to be brave and talk about things that, again, it may not be comfortable, but avoiding it doesn't make it go away.
Well, the retirement advisor focuses on these things, right? Because these are significant. You know, we've talked to diversification in past week's shows. Last week, we talked about the fees and cost. And in so many ways, Jay, the financial advisor who charges those percentage-based fees that we talked about in that episode, they're not necessarily motivated to help people with tax planning. Because when you're doing tax planning, you have to take money out of those accounts, right? Which means that if you're taking money out of those accounts and being and taking, now all of a sudden that's impacting the bottom line for that advisor who's being charged, who's charging based off of the percentage of those assets. So they're de-incentivized to help and equip folks with those kinds of plans. I mentioned the CPA is I'll steal a line from a CPA friend of mine. They're history teachers. They're looking backwards, which leaves you have to be working with a retirement advisor, somebody who's focused on these areas. So if you're out there, what are the things that you need to be asking about as it relates to your plan? It's understanding in terms of, taxes and how they work. And what I mean by that, you don't need to get into the nitty gritty. This can be a complicated area, but you need to ask, okay, where's my effective tax rate? And let's talk to that in a moment. But what does my effective tax rate look like if I were to lose a spouse, right? What is that? What are the long-term tax impacts if my money passes on to my kids or other beneficiaries? What happens then? There's a lot of things that folks need to be asking about, but let's talk a minute. There's these words out there: effective tax rate, marginal tax rate, tax brackets. Let's come back down to earth here, Jay, and maybe I'll spend just a moment talking about this, and you'll clean up my mess here. But I can't tell you how many times over the years I've met with folks, and they're like, Pat, I want to stay out of the blah, blah, blah tax bracket. I want to stay out of the 22% tax bracket. Most Americans believe that if $1 goes into that 22% bracket, that all of their money is taxed that way, right? And that doesn't happen, right? If $1 goes into that 22% bracket, just that $1, that $1 is taxed at 22%. Right now, we have a favorable tax rate. We do, regardless of your politics, right? And if you're over 65, there's some additional tax bonuses. Well, the standard deduction, which means that nearly $30,000, $35,000 of money, if you're a married couple, is taxed at 0%. I'm going to say that again. Over $30,000 of retirees' money is taxed at 0%. Then some money gets taxed at the 10% rate, some at the 12, and so on and so on. And even the wealthiest Americans have those same standard deductions, right? So we are in a very favorable tax bracket. So people get caught up on, hey, what tax bracket did I land in? Well, that's not what's important. The effective tax rate, which is the actual pennies on the dollar, Jay, that you pay in taxes.
And even looking at that tax bracket, at that $32,000, let's say for a married filing joint, one of the spouses passes away, you're the surviving spouse, you file single, now you're $16,000. Yeah. So if your income remains the same, you've automatically escalated how much you're paying in taxes every year. And that's painful. That's, again, not necessarily realized, which is why in that conversation, she holds up her tax return and goes, I don't know what happened. Unfortunately, that traumatic event of losing your spouse now has not equally, but certainly some level of trauma. When you go to your accountant and you pick up your taxes and go, oh, by the way, bring your checkbook because you need to write an extra balance.
So the widow's tax strap is what we're talking about today. And here's what often happens. You just made mention of that. Income and lifestyle doesn't necessarily change that dramatically when a first spouse passes away. So now all of a sudden that person, whether it was $80,000, $100,000, or $120,000, more or less, their income still remains the same. But if you look at effective tax rates or look at tax tables for that example, individual tax rates are nearly twice as expensive as married tax rates.
And that's real money. That's real money at a time where you're automatically looking at taking some distributions. There's lots of things that go into the retirement world that you don't necessarily think about while you're still working. This is part of it that needs to be planned for. We can't just go willy-nilly into a retirement plan and go, great, we have a large pool of money that we can draw on. We're going to be okay. If we don't have a plan to understand what these taxes look like, how to deal with them proactively versus retroactively, there's a big savings in doing that.
Now, with these 401ks, with these IRA accounts, made mention before, these dollars are going to be taxable. And there are what it's called RMDs, required minimum distributions, right? For the longest time, it was age 70 and a half. What a weird age, but 70 and a half was the time where you had to start required minimum distributions. Then it went to age 72, and then it went to age 73. And then it all depends on where you're born. But I believe if you're born on or after January 1st, 1960, correct, it's now age 70, 75. And if I mess that up, Adam, our producer, he can, go back and clean that up. I'm getting a thumbs up from Adam. We need to get him a microphone at some point. Yeah. Jump in here. So what that means is at those age, you now have required minimum distribution. So going back to that surviving spouse, to that widow, right? Those required minimum distributions also continue, right? So if a married couple passes away, doesn't matter, male, female, whomever now is a surviving spouse, they now have to still take required minimum distributions. Well, they can now pay twice as much in taxes because they're a single filer versus being a married filer, right?
As we break that down, I like playing wordsmith every once in a while, and I think about required minimum. It's required. It has to happen. Dollars that haven't been taxed will be required to be withdrawn, will be required to be taxed. That required is there. It's not maybe minimum deduct. It's required. It has to take, and then it's minimum. So it's only a small amount. What's interesting though is it starts out small and then can grow over the years. And so these dollars come out, they have to be taxed.
100% tax. They are 100%. Every dollar of those monies that come out are taxed.
Every single dollar. There's no break. If you take out, if it's $10,000 goes into that tax world and increases your tax bracket, if you will, potentially based on what those dollars look like. Yeah. And so you mentioned a minute ago, effective tax rate. Dig into that a little bit.
Yeah. So the effective tax rate begins, again, as the pennies on the dollars that you pay in taxes. And right now, in so many ways or so many words, taxes are on sale, right? So let's take a couple age 65, right? And let's say they have pensions, Social Security, and for most Americans, those aren't necessarily enough to cover their month-to-month expenses. So they're taking out, there's an income plan here to take out money out of their retirement account. At least they should if they're working with our strategy, with our team. Well, listen, that puts them at an effective tax rate. Often when we run that analysis, that effective tax rate might be 4.6, 7.3, 8.9%, right? Because it's taken in consideration. Some money's taxed at 0%, some is at 10, some it's all these different levels. Where that provides a framework, Jay, is an opportunity to take out above and beyond what you need each year and move that into some tax favorable strategies. And I'll circle back to that. But before I do, let me talk to the myths that we see far too often, right? Because far too often we see that same 65-year-old couple working with one of those financial advisors who is lazy and doesn't talk to tax planning. Soapbox moment there for me. But what happens is they'll just say, hey, listen, you don't need to do tax planning. Just take that out and then we'll take out your required minimum distributions. Again, go back to our last week's episode to talk about their financial motivation behind that, on how they charge their fees. But what now happens? Let's say that account is at age 65, let's just call it $500,000. And let's say their required minimum distributions will now be at age 75. So there's a 10-year gap there, right? It is very fathomable to think that in 10 years, if they're averaging around 7%, right, that all of a sudden that money is now worth $1 million, right? So 500,000 is now $1 million. You might be sitting there, Pat, well, that seems like a pretty good deal. They just, we just doubled our retirement accounts over a 10-year period, even taking withdrawals. But this is where the payday happens for Uncle Sam. So understand, Jay, yeah, Uncle Sam is a greedy uncle, but Uncle Sam is also a very patient uncle. And this is where that patience, yet persistence will pay off, because now let's fast forward and let's say at age 75 or 76, let's say one of the spouses pass away. Well, now they have required minimum distributions off $1 million account. And now they're taking out those chunks each and every year. And now that surviving spouse now has to pay taxes at their individual tax rate. Not only does that skyrocket their tax bracket, but what's that do for healthcare, Jay?
Exactly. If we don't address what this looks like from an income standpoint, with Social Security, you have money coming in. With pensions, you have coming in. With your investments, you have money coming in. Now with Medicare, there's this thing called IRMAA, Aunt Irma. It's identified, and it's an income-related I don't remember the acronym. Income-related adjustment, basically, of what that looks like, where you would actually pay more for your Medicare. Your Part B premium goes up at that particular point. So if we look at, let's say that we don't do any tax strategies, and this individual, 65, her husband passes away prematurely, and over the next 10 years, there isn't anything done. Let's talk about the flip side of that. So at RMDs, required minimum distributions at age 75, and let's say that she lives a long, healthy life to 90 or 95 years old. Nothing is done from a tax planning standpoint, and she just pulls out those RMDs every single year. $500,000 portfolio shows in excess of $300,000 worth of taxes paid on that $500,000. Then it typically might put her into that IRMAA classification, which is one number for...
It could be a 500% increase at that point.
Absolutely. Yeah. One of the things that the government can do that is a little bit, they can't necessarily change a whole lot with some of the things, but with IRMAA in particular, seeing what those numbers are, they go, you know what, we need more taxes, so we're going to increase that IRMAA ratio currently for right now.
So IRMAA is essentially, if you're not to Medicare age yet, is your Medicare Part B premium.
Correct.
Right? And age 65 and older, they look back 2 years prior and can hit you with an additional Medicare Part B premium cost based off of your income bracket. And those levels are significantly compressed and penalized, and it's a trap for those widows, spouses, right? So let's talk to smart planning. More importantly, let's talk to some proactive tax strategies.
One of the things we like often to talk about is Roth conversions. As we bring Roth conversions into this, it's something that, again, I've said it in the past, and we'll say it again. Nobody likes paying more taxes. I get that. Yet a little bit, maybe for our audience of those folks that might be closer to retirement or in retirement, remember the old Fram oil commercials. Oil filter commercials. And there was a mechanic, and he was talking about your engine and taking care of it and just the importance of changing your oil on a regular basis. And the concept was, you can pay me now or you can pay me later. If you pay me now, he holds up a Fram oil commercial. Maybe we should get royalties from Fram for talking about that. But that meaning it's just a small amount to change your oil on a regular basis. But if you don't do it, you have a huge expense of replacing your engine or buying a whole new car down the road. Our taxes aren't very dissimilar from that as well. We can pay a little bit now, or we can pay a lot later. And the choice is ours. We get to choose what that looks like by being proactive. So that Roth conversion understanding of taking pre-tax dollars and moving it into a Roth account. And so there are a lot of benefits to it, very few, if any, concerns about doing it, because those dollars, when you get to RMD, if you don't have any dollars that haven't been taxed, double negative, but if you don't have any dollars that are still needing to be taxed, there's no RMDs. Mm-hmm. So talk about Roth conversions.
Yeah. So first of all, this happens with intentionality, right? So you're taking money out of these tax deferred accounts, 401ks, 403bs, 457s, thrift savings plans, the list goes on. And with intentionality, with purpose, and with great direction, taking those dollars out, right? Still controlling your effective tax rate, being mindful of IRMAA tax penalties, and doing so, and now taking those dollars and putting them into a tax-free account, where now the earnings, as an example, that Roth IRA, and there's other strategies that function this way, now those dollars are growing tax-free. Tax-free when you and your spouse go to live off of those dollars. The Roth IRA, those tax-free accounts pass on tax-free to the surviving spouse. And oh, by the way, those also pass along entirely tax-free on to the final beneficiaries, where now the greedy, grubby Uncle Sam, whatever I called him before earlier, right? Now all of a sudden, he's not getting a significant chunk of those dollars, right? You're controlling, and now it's your tax strategy. It's your tax plan. It's not Uncle Sam's tax plan.
Huge. When we can dictate that when we pay taxes, how much we pay. There are laws that we need to abide by, obviously, as far as what those numbers are. Yet when it's on our schedule, it will be much more advantageous. So we're talking about the widow's penalty or the widower's penalty from that perspective to see how that impacts them. Part two, when you talked about as well about that idea of Roth conversions and passing on to the children, we now are starting to talk about this thing called the kiddo's penalty. So when we understand that those dollars pass on that have been de-taxed already, they've grown tax-free, you pass away as a surviving spouse, and there's a legacy for your child, children, grandchildren, nieces, nephews, whoever it may be, those dollars pass on and there's no tax implication on that. So, that is magnificent.
So in other words, it's paying a little more tax today,
right,
for massive tax savings later on.
Fram oil commercial. Yeah. Pay me now or pay me later.
A little bit now. And kind of back to what we've talked in the past, which is control the controllables. We know what tax rates are today, right? Towards the end of the year, we'll know what they are for next year, right? There's a framework that we know this administration, hey, here's our current tax code. Well, the national debt in this country is not lowering, right? Continues to go up. If we were to pull all the viewers out there, I'm guessing the mass majority, if not all of them, would likely say that tax rates are all going to go up in the future, right? And so that person that has a $500,000 and grows to $1 million 10 years from now, when they just go to take those required minimum distributions, they're going to get clobbered, Jay, on where their taxes are. They're going to get clobbered even if tax rates would stay the same.
Right.
But if tax rates get even more expensive and now they're paying on those things, it can be tragic. So being mindful now. We've used this word in the past too, and I love it. So I'm going to say it again: coordination. Yeah. Right. This coordination needs to happen. Being mindful of a lot of these different areas you're hearing about. Working with a retirement advising team that specializes in this planning is so important. And it's all about how much that you keep. Right. Growth is important. Right. Growth will always be important, but making sure that how much you keep is even more significant. But the coordination happens with having a great income plan, right? And if all of your money, or I should say, if you're starting to really work on getting monies tax diversified, think about what that does for you from an income purpose as you're now living off of monies that are tax-free into the future, right? So there's a lot that happens here. The coordination that happens with healthcare, long-term care. You mentioned the Medicare Part B premium, all these things that likely are, maybe having you melt that are out there, but these things need to happen in coordination. If you are near retirement or in retirement, even if you're already of required minimum distribution age, even if you are a widow, there are still tax planning strategies out there that can happen for you. It's not too late, right? So there's still some great opportunities. But if you're a young person out there that's watching today, there's some things that you can do leading up to retirement to better position you to make sure that you're not going to be setting up your spouse, your family for these other tax traps that are out there.
It is. Too oftentimes we think that tax trap is nothing more than April 15th. It's a big red circle on our calendar and, oh my gosh, taxes are now. Taxes really ought to be a conversation at some point through the other 364 days that we deal with. It's not something that we just deal with when we have to send that envelope in and make sure it's postmarked by midnight on the 15th. There are so many different things that the conversation has to go on. And it's not a one-time conversation. You mentioned that what does it look like next year when hopefully the values grow in our accounts. And so now what's that RMD look like? If we can eliminate that ahead of time. I like the idea of being proactive versus reactive. And if, in fact, we are proactive in that process, the benefits are generational. It's not just a today issue. We make decisions today that will impact generations to come, maybe even generations that we'll never know.
Yeah, the purpose of doing this type of planning is more control, more freedom, more flexibility in all things that you do. So the earlier that you start, certainly the better. Today we're obviously focused on the widow's tax strap, but truth be told, Jay, that's not the massive moneymaker for Uncle Sam, right? The Secure Act was put in place by our government to then put restrictions on when the next generation receives these monies. You want to talk to that a little bit?
Yeah.
This is the big payday.
This is a big payday for them. So if we have the largest transfer of wealth coming up in the coming years, this economic boom for Washington, let's say, and maybe even for those next generation, the secondary beneficiaries, let's call them. When we understand what that looks like, the money that's coming into them, those dollars are great. We can look and say, yeah, mom and dad, and we're going to inherit this. Well, what's taken place in Secure Act 2.0 is backing up a little bit. Used to be, years ago, we'd get some money from grandma, grandpa, or whoever that would pass away, and we can take those dollars out when we'd want and pay taxes on them at that particular point. And so, okay, that's fine, and we have a little bit more control over that. What the government did that came in and very strategically, very systematically, now there's a 10-year window that those dollars have to be withdrawn. So when mom and dad pass away and that $1 million, let's say, that's left over goes to two individual children, then they are each inheriting $500,000, just using some round numbers. And those dollars must come out in a 10-year window. It doesn't have to come out all at one time. It can be spread over that 10-year window. But that comes into their lump of income. What if they're at the point where they're at maximum income earning age? And we talked earlier about tax brackets.
Likely at their peak earning years.
Likely at their peak earnings. So maximum income earning age. And in those dollars that are coming in, now that just sits on top. It maybe is a cherry on top of a cake, but that's a big cake and that's a really big cherry that might need to be adjusted. So now they might be actually going into another tax bracket where you mentioned that $1 that would go into, say, 22%. What if 50,000 goes into that 22%? Yeah. That's significant. So we can see that secondary, the kiddos penalty, certainly double, maybe even triple their taxes. And whereas it's nice to have some of that money and you do get to keep what's left over, let's keep a little bit more by being proactive on the front end.
Yeah, someone might be listening out there, Jay, and thinking, whatever the kids or whatever those final beneficiaries receive, it is what it is, and then they'll have to pay taxes on those dollars. And maybe you could think that way. It's your money, and right. So if you want to, give more money to Uncle Sam, that's completely your choice. But a lot of folks, what they think about is just the taxes on what they're going to receive. And what they need to recognize is when they receive that inheritance, if it's fully taxable, like these dollars we're talking about, that kiddo, their own salary, their own wages also get taxed at a much higher level. So as the government set up this Secure Act, really what they're looking at is, all right, how can we maximize the taxation on these dollars? And so many Americans are walking blind and don't have a retirement advisor that's helping them navigate these issues, that this is going to be a massive windfall for Uncle Sam. And I'm not anti-government. Listen, Jay, I like good schools and clean streets and a strong military. But I think most of us, don't necessarily trust the yahoos in Washington, D.C. So let's just not give them any more money than what we have to.
And if we haven't had a budget in this country since 2009 assigned, but what's our household look like if we don't have a budget that we're living by and we just go off and spend willy-nilly? Well, the answer is there's $1.9 trillion typically on average that's taken in from taxes every single year. So we also know that there are fixed accounts in government like Medicare and Social Security. Oddly enough, that equals about $1.9 trillion. So the good military that you're looking for, where's that money come from? We now are in deficit spending. We now have to raise taxes, whether it's direct tax information, whether it's IRMAA information on your Part B of your Medicare, whether it's the widow's penalty, the kiddo's penalty. There has to be some level of creative financing in Washington to help pay for some of these. Again, we're in the same boat as far as not beaten up on things, but we can't just arbitrarily go, well, great, we'll just charge more to make more money. That's how we solve our problem. But that's kind of what it looks like. And respectfully, that's exactly what it looks like. Right. So when we have these and we know that these taxes can be significant for the widow and can be even more significant for the kiddo, what do we do with that? We must be running in front of this a little bit so that we can understand more clearly the impact. Again, I say this often, it's not the splash, it's the ripple. We have to deal with that ripple. We can't just stick our head in the sand and go, well, that's taxes or that is somebody else's problem. Again, maybe that's that mindset. I dare say that's probably a minimum of the people that are listening kind of go, and that's their problem. Because if that were the case, why are we interested then in the legacy plan? Why are we interested in passing some of those dollars on? So having an understanding, having a plan, having something that brings confidence and clarity into the conversation is something that doesn't take a long time to talk about, but it is something that we definitely need to have that conversation.
Yeah. If you want to understand what this can look like for you, we'd encourage you to take the next step and schedule an on-track retirement review. You can do so, engage with us by visiting myontrackretirement.com. Again, that's myontrackretirement.com. We'll cut through the stuff. We'll walk through your current tax exposure. What happens if one spouse were to pass away? What's the long-term tax liability that you could potentially be facing? And to that extent, if this conversation's been beneficial to you, if you've had a couple aha moments, the light bulb's gone off a little bit, be sure to like and subscribe and pass on. Thank you for doing that already. Share this with some of your friends as you have conversations in the neighborhood or with those folks that you go to church with or go to dinner with or have bridge club with or whatever it may be that's going on. Because if we can impact your world, we can typically impact theirs. We want to educate you so you understand what retirement looks like so that you have a much brighter future. And Jay, next time we're talking about why age 60 may be the most financial dangerous age as it relates to retirement planning. Thank you so much for visiting with us today. We wish you a wonderful week, and we'll see you next week.
Goodbye.